Hey everybody, Gary at Basecamp Trading. Welcome to Intro to Trading. What are OSO orders and OCO orders? OSO stands for Order Sends Order, and OCO stands for Order Cancels Order, or sometimes you'll hear it referred to as one cancels the other. An OC order, or Order Cancels Order, consists of a group of two or more orders that are linked together in a way that if one order is filled, then all the other orders are canceled. So for example, let's say you have an OC order consists of two orders. One is a limit order to buy 500 shares of something, an instrument, and the second order is a stop order to sell 200 shares of another instrument. If the limit price of number one is hit and fills, then the stop order for number two is automatically canceled. So that's an order cancels order. So in other words, if one order is filled, then the other order is canceled. So that's an order cancels order. And there's no limit to the number of parallel orders in a order cancel order group of orders. When any one of them is filled, all the rest of them are canceled. So if you have an order to buy 500 shares of something, an order to sell 100 shares of something else, and another order to sell 100 shares, another order to buy 100 shares of something else, when one of those are filled, all the rest of them are canceled. A bracket OC order consists of two exit orders with the same symbol, quantity, and order action. And the way that works is, let's say, for example, you place an order to purchase 500 shares of stock for $100, and you want the stop loss to be if that stock drops down to $75. Or you want to take profits if the stock goes to $110. Well, you can place your buy order to buy it at 100, and then it'll place the stop loss to sell it at 75 or take profits at 100. Well, if it drops down to 75, it'll cancel the take profit order at 100, or if your stock goes up to 100, it'll fill the 100, sell it, and it'll cancel your stop loss order. So that's a bracket, one cancels the other order. An order sends order is a little more complicated, and what that consists of are a primary order that will send one or more secondary orders when the primary order is filled. So for example, you have an order send order consisting of three orders. The primary order is a limit order to buy 1,000 shares of something, and attached to it are two other orders, a limit order to buy 500 shares of another symbol, and a stop order for 1,000 shares of the primary symbol if that drops below 25, or goes 25 cents below the limit price for that original order. When the primary order is filled, the two additional orders are sent, one that buys the additional shares of a related symbol and another that sets the stop loss for the primary order. So again, if you want to buy 1,000 shares of a stock for again for $100, and you want a stop loss to be placed for $99.75, and then but at the same time you want to buy 500 shares of something else. If the shares of that 1,000 are filled, then you put an OSO order, and as soon as your 1,000 shares are filled, it'll send a order to place your stop loss for your initial purchase. So again, if it was purchased at $100 and you want that to be your stop loss at $99.75, it'll send that order, place your stop loss, and it'll also send an order to buy the shares of the other instrument that you were wanting to buy. So, and OSOs and OC orders, they primarily are a way to manage an order or even manage a trade when you're not at the computer. The most common one is the OCO order, where it's one cancels the other. And again, that's usually, if you buy 100 shares of something, or let's say, for example, you go long a futures contract, because this applies to futures, forex, stocks, options, whatever instrument you want to use. But so, for example, if on a futures contract you want to go long crude oil at $38.38, and you want to take profits if crude oil goes to $38.88, or you want to stop out if crude oil goes to $38.28. So you'll place your order. It'll fill if your price gets hit at $38.38. If crude oil moves up to $38.88, it'll take profits and cancel your stop loss order. Or if crude oil drops down to $38.28, it will stop you out and cancel your take profit order, because your take profit order is going to be a sell order at the higher price. So if you're buying at $38.38, you're going to sell at $38.88, and you're also going to sell if it goes down to $38.28. So whichever one gets hit first, it'll cancel the other, because let's say, for example, crude goes up to your $38.88 and it sells, but then you have your stop loss still set, which is actually a sell order at $38.28. Well, if crude drops down to $38.28, it'll sell that if you don't cancel the order. So when you place an OCO, one cancels the other. Whichever one gets hit first, it'll automatically cancel the other one, so that you don't have an open order sitting there if you're not at your computer. So that's what an OSO order and an OC order is.